Let's get to the closing bell exchange today. Laurie Calvasina from RBC Capital Markets, Fred Lane from Lane Generational, that's part of Raymond James, Rene Nourse from Urban Wealth Management, and Jack Bouroudjian from UCX. A very good afternoon to you all. Rene, I'll start with you. What are your clients saying to you? Are they concerned, and should they be?
Well, I know it's been a while since we've had the traditional October wonkiness, but this is where we are. And I really do think that we're really in a correction mode. So it's not about shifting from a bull to a bear market right now. I see this as an opportunity for us to look at some areas that are going to represent the best places in the industry to be. And it doesn't surprise me, nor does it surprise our clients, that certain sectors are really being slammed. So the industrials, the auto manufacturers are definitely, as an example, are being very much victimized by the change in our foreign trade and our U.S. dollar strength. So we are looking at certain areas that are going to represent some major opportunities.
So, Laurie, you put together an earnings report card. Do the reactions that we're seeing, and some of them are looking pretty violent at this point, justify what we're getting out of these company results?
Well, I think at this point, I mean, you've had just this massive outperformance this year of the growth trade in particular. And what we're seeing is companies really have to be perfect, not just perfect for this year, but really need rosy expectations for this year. And if you're falling short in any way, shape, or form, you're getting punished for it at this point.
Jack, I wanted to ask you about the U.S. dollar. We spoke about this the other day, the fact that it was taking out the 96 handle. Talk us through the levels it's at today, up 0.5%, and what that means.
Well, Wilf, I think you could see what's happening in Europe, especially. You know, when we see what's happening to the euro currency, when we see what's happening to cable, a lot of those institutions abroad are suffering. That's the ancillary implications of a strong dollar. Now, having said that, what we also see is money being taken off the table, whether it's a large sovereign wealth fund or whatever the case is. We are seeing large asset allocations, money going out of the stock markets and going into the fixed income market, which is really a price dislocation and causing a lot of uproar around the world. You know, the real question is this. Over the course of the next 2 or 3 months, I think we should expect the dollar to continue to go higher because of repatriation, and this dollar demand on these swap desks is unprecedented. So the real question is what happens to the rest of the world as we see the dollar continue to go higher. And I think what's going to happen is that more than likely we're going to see a little bit more of this. Unfortunately, we haven't seen enough pain yet. And I hate to say it that way, but until we see the VIX spike up to 30, until we see a bid in gold, I don't think we're done yet.
So, Fred, you were looking for a correction, though you say you remain largely bullish. What's keeping you bullish, and how do we know when sentiment turns?
Well, I was looking for a correction in late September. I actually communicated that to one of your producers. I reminded her this morning, and you know, these corrections kind of go with the territory. There was a major correction in 16, not major 5%. There was a 10% correction in early 18, and right now we're down about 8.5%. So these aren't these aren't unexpected. You know, our clients actually are sending us more money. Ironically enough, their basic view is this isn't the end of the world. This is a buying opportunity. But it is interesting that only 4 sectors, I'm going to exclude utilities because they're up about 2.5% this year, and we don't play in utilities at all. But only technology and healthcare and consumer discretionary are up year to date as S&P sectors. That doesn't surprise me. That's where the secular growth is, and I think that's where you have to invest. And when you start to invest in areas that are vulnerable to cost inputs, to regulation, to trade policy, then you're on thin ice. And I think so. We're trying to steer away from that, and we believe that secular growth will continue to carry the day, as it has for a long period of time. And oh, by the way, those sectors have gotten beaten up. They have indeed, but they're still up for the year substantially.